Now, the Buffett test. This is extremely important.
Could you please explain how you differentiate between types of businesses in your cash flow valuation process, given that you use the same discount rate across companies? For example, in valuing Coke and Geico, how do you account for the difference in the riskiness of their cash flows?
We don't worry about risk in the traditional, the way you're taught actually at Wharton. We, but it's a good question. Believe me. But if we could see the future of every business perfectly, it wouldn't make any difference whether the money came from running streetcars or from selling software, because all the cash that came out, which is all we're measuring between now and Judgment Day, would spend the same to us. The industry that it's earned in means nothing except to the extent that it may tell you something about the ability to develop the cash, but it doesn't tell you. It has no meaning on the quality of the cash once it becomes distributable. We look at riskiness essentially as being sort of a go, no-go valve in terms of looking at the future of businesses. In other words, if we think we simply don't know what's going to happen in the future, that doesn't mean it's necessarily risky. It just means we don't know. It means it's risky for us. It may not be risky for someone else who understands the business. In that case, we just give up. We don't try to predict those things. And we don't say, well, we don't know what's going to happen, so therefore we'll discount it at 9% instead of 7%, some number that we don't even know. That is not our way to approach it. We feel that once it passed the threshold test of being something about which we feel quite certain, that the same discount factor tends to apply to everything. And we try to do only things about which we're quite certain when we buy into the businesses. So we think all the capital asset pricing model type reasoning with different rates of risk-adjusted return and all that, we tend to think it is, well, we don't tend to, we think it is nonsense. And but we do think it's also nonsense to get into situations or to try and evaluate situations where we don't have any conviction to speak of as to what the future is going to look like. And we don't think you can compensate for that by having a higher discount rate and saying it's riskier so that I don't really know what's going to happen, I'll have a higher discount rate. That just is not our way of approaching things. Charlie?
Yeah, this great emphasis on volatility in corporate finance, we just regard as nonsense. If we have a statistical probability of putting out $1 million and having it turn into put it this way, as long as the odds are in our favor and we're not risking the whole company on one throw or anything close to it, we don't mind volatility in results. What we want is the favorable odds. We figure the volatility over time will take care of itself at Berkshire.
If we have a business about which we're extremely confident as to the business result, we would prefer that it have high volatility than low volatility. We will make more money out of a business where we know where the end game is going to be if it bounces around a lot. I mean, for example, if people reacted to the monthly earnings of Seas, which might lose money 8 months out of the year and makes a fortune, in November, December, if people reacted to that and therefore made its stock as an independent company very volatile, that would be terrific for us because we would know it was all nonsense, and we would buy in July and sell in January. Well, obviously things don't behave that way, but when we see a business about which we're very certain, but the world thinks that its fortunes are going up and down, and therefore it behaves with great volatility, we love it. That's way better than having a lower beta. So we think that we actually would prefer what other people would call risk. When we bought the Washington Post, I've used that as, it went down 50% in a matter of a few months. best thing that could have happened. I mean, that doesn't get any better than that. Business was fundamentally very non-volatile in nature. I mean, TV stations and a strong dominant newspaper, that's a non-volatile business, but it was a volatile stock. And that is a great combination from our standpoint.
So, should you invest in a certain stock right now? The Warren Buffett test, according to Yahoo Finance. In Buffett's annual letter to Berkshire Hathaway, shareholders released in 2014, he explained a test that he and his long-time business partner Charlie Munger applied before buying any stock. Now, this can also be applied to 10 years in the future as well, so on and so forth. So this is pretty much a timeless test that Buffett has put forth. There are 2 steps to the Buffett test. Determine, number 1, if you can sensibly estimate an earnings range for 5 years out or more. Number 2, if the answer is yes, then buy the stock only if its price is reasonably compared to the lower end of the estimated earnings range. Now, you might wonder if Buffett sometimes bends these rules a little bit. Now, for example, he would still buy a stock if it passed the test, but the overall economic picture looked uncertain. Would he buy a stock if Wall Street hated it? The answer is a resounding yes. He wrote to Berkshire Hathaway shareholders nearly a decade ago, quote, "In 54 years, he and Munger, have worked together. We have never foregone an attractive purchase because the macro or political environment or the views of other people, in fact, these subjects never come up when we make these decisions." Back to the Yahoo Finance article. Easier said than done, however. While the Buffett test for buying stocks is straightforward, it's easier said than done. The most difficult part is estimating earnings for a company for the next 5 years or more. So you really should take a look at this test, in my personal opinion. And let's talk about stocks that would in fact pass the test, because it's very important to give examples here. Now, 2 stocks that would pass the test right now as recording this video. Buffett hasn't bought many stocks in recent quarters, evidence that he isn't finding many that pass the test. However, I think that some may pass the test right now, according to what he thinks, and possibly what Buffett would buy. Here are some of them. Dr. Horton. Now, DHI is one of them, and Buffett has, in fact, bought this particular stock back in 2023. So, despite its shares earning of 70% last year, Dr. Horton trades at only 11.4 times expected earnings. That makes the stock attractively valued, even if the company barely increases its earnings at all over the next 5 years. But Dr. Horton should be able to... Now, Dr. Horton, just so you know, is a home building stock. It's a stock that I have personally taken a deep dive and look into, and I do believe they are the #1 home builder in the United States. Now, for another stock, according to Yahoo Finance, Meta Platforms is another one that may in fact fall into this category of Buffett stocks that pass this particular test. Buffett doesn't own Meta Platforms. However, it is a definite possibility that it passes the circle of competence with Warren Buffett. So Buffett's really simple alternative, to really bring it down to this: each investor should follow Buffett's 2-step process on their own before buying any stock. Now, don't worry, according to Yahoo Finance, if you aren't comfortable estimating earnings, Buffett has a really simple alternative that doesn't involve his test at all. He argued in his letter to Berkshire Hathaway shareholders in 2014 that most investors would be better pulling their money into a low-cost S&P 500 index fund instead of trying to pick individual stocks. Buffett even predicted that anyone who follows this advice is virtually certain to get satisfactory results over the long term. So S&P 500 of course, is pretty much your safe bet in terms of, trying to build wealth over the next, 10, 20, 30 years instead of trying to pick out individual stocks. That could be very difficult for people like McDonald's, like Apple, Facebook, Meta, you know, certain stocks such as that. It could be very difficult to pick out all of the best stocks on the S&P 500. Now, me in particular, I have looked at every single stock on the S&P 500 myself. Now, going through that yourself may take a bit of time and effort and energy, and you may not be able to decipher which exact stock that you should pick to invest in. So the S&P 500 index fund might be for you. So it's a very big possibility that that could be, your potential best outlook for investing in the next like 10, 20 years if you wanted to go that route. So it really just depends on what you want to do and what you're comfortable with in terms of investing. Now, again, always take a look at everything under the sun before you invest anything. That's what I particularly do. I always research every single company as much as I can, try to understand the business, try to understand the business model and all of that. And, as long as you really do the research and do the homework, in 10, 20 years down the road, then you really should be fine. So, remember to leave a like, comment, subscribe, hit the notification bell for more. What do you think of Warren Buffett's advice here? Do you think it's good? Do you think it's bad? What do you think? Thank you so much for watching, everyone, and I really do hope you subscribe and watch the next video. Thank you.